Here's the list of common equity accounts that we'll be using in this course. We may add a couple more, but this is a good starting point. If you were to look at a balance sheet and you were to only see something like Kevin Kimball Capital, immediately you would know that this is a sole proprietorship because there's only one capital account and it's named after the individual sole proprietor. Now, if you were to see two or more capital accounts with people's names on it, you would know that that's a partnership. If you were to see something like common stock, preferred stock, and retained earnings, these would represent that this is a corporation. Common stock and preferred stock are types of stock that are given to owners in exchange for resources. Retained earnings is the amount of income the company has earned and the owners have chosen to keep within the company rather than have them pay out in the form of withdrawals or dividends. Dividends would be the appropriate term if we're dealing with corporation. Withdrawals would be the word we use for partnerships and sole proprietorships. These equity accounts keep a permanent running total of the company's total equity. They appear on the balance sheet. They're known as permanent accounts because they keep a running total year after year after year. These equity accounts are only temporarily used during a given period to explain why these balance sheet equity accounts changed from one year to the next, or one accounting period to the next. Capital distributions, withdrawals, and dividends appear on the statement of owner's equity or shareholder's equity. Withdrawals and dividends are payments to the owners out of the company's earnings, and capital distribution is effectively giving them back their original capital. Revenues, gains, expenses, and losses appear on the income statement. If you take all the revenues and gains and deduct all the expenses and losses, you will arrive at net income. Net income serves to increase retained earnings.